I'm catching up with Ben Finger, who's the CEO of the Haben Property Fund, and they've got a new investment coming out, and I want to talk to him about it so I can fully understand what the project is all about. Ben, thanks for joining us.
Thank you for having me, Peter.
Now, look, I know you guys have been advertising on Switzer Daily, and so I thought it might be a good idea to actually fully understand what you're trying to do. And I can't endorse anybody because,
Sure.
End of the day, you are potentially offering better returns than term deposits, and we know it means that they're more risky than term deposits. You're not government guaranteed. But a lot of people have invested in these sorts of investments like yours, and historically have done pretty well. So, tell us about Haben Property Fund.
Thank you for the opportunity, first of all. So, Haben Property Fund is a business we've been around now for 13 years. The business, Haben being Harold and Ben, my father and myself, we started this together. We started it quite organically. We were doing our own private projects and essentially approached by some friends and family that wanted to co-invest, which for us was a fantastic compliment. And having that in the back of our minds, we decided that that made sense at the time to co-invest our money with other people's capital, which would give us the opportunity really to buy some larger assets at better prices than what we'd traditionally be buying when we're competing with a larger pool of people for smaller sized assets. And in going through that sort of exercise with ourselves, we decided that we wanted to focus in on one sector and be an expert in one area rather than try to be players in all sectors.
Yeah.
And so we landed on what we call food and service-based shopping centres for two prime reasons. One, it had a very reliable cash flow being linked to food and services. And the second piece that really compelled us was the fact that they're all underdeveloped sites. And all these shopping centres sit on really large parcels of land, with large car parks sitting around them with the shopping centre traditionally in the centre of it. And this land that sits around it, it's all mixed use zoned, so it really gives you the possibility to be able to unlock some sort of upside on the site, and that's by way of getting a planning approval through or a development application approved through on the site for another use, whether it be office or residential, medical. And that doesn't necessarily mean that we need to build it per se, but just by getting the approval on the site, it enables us to get some upside and great value on the shopping centre.
Okay, so can you give us an example of an investment that's like the one we were talking about in the moment?
Sure.
Where what was like when it started, what did you do, and what was the outcome?
Yeah. So by nature, we're opportunistic. We like to find things where there's an opportunity to add some value. So, a site that I can think of is one that we exited out of a bit over a year ago. We bought in Western Sydney, a shopping centre. It was an unloved centre. Great location, tick, good sized parcel of land, tick. On a transport node, it was right on a train station. But it had really just been unloved by the current vendor, and for us, and because it was unloved, a lot of people passed it up on the market and just took it at face value. We saw a great opportunity there, and as such got it at some great pricing. At the time, we spent many years improving the asset itself, improving the tenancy mix, renewing the length of the leases longer with the tenants, which gave it more of a reliable cash flow for a longer period of time. Improved the experience for the shopper by putting some new and better lifts inside there. So all in all, improved the investment asset itself. But then on top of it, during the tenure of ownership, we got approval for 600 units on the site there. And when it came time to selling the asset, not only did we get the value of the shopping centre, but we got well above the odds on the value because the incoming purchaser had to pay for the price of the value of those apartments.
And did that purchaser continue to run the shopping centre and then move to start building units on the land?
So that would be the longer term intent,
Yeah,
absolutely,
okay.
yeah.
And so invariably then I presume you sell to an organisation that's bigger than you, or else got bigger dreams and is prepared to borrow and whatever.
Or to that point, 100%. And guys that or companies that set up to build hundreds of units. We don't consider ourselves to be a developer of hundreds of units. We can add value by getting the approval and the right type of approval on the site.
Yeah. What has been the least successful activity you've done, and why was it as less successful?
Probably the one that comes to mind would be a shopping centre we acquired many years back in Melbourne, and that's not to say that the overall outcome wasn't still good, which it still was good, but in terms of time that it took us to execute on the strategy that we set out to do, it ended up taking longer, and there was a fair bit more work. This was a shopping centre that was really in dire straits, and it did need major refurbishment and a major overhaul, and so we undertook to do that, but because of market circumstances at that time, it ended up being that whole exercise took longer. One of the things that impacted it was the start of COVID as well. It was outside of our control to some degree, and other things that impacted it. Was the banking environment at that point in time as well. They were less likely to lend as much as they wanted to. And for us as owners, we want to deliver always on what we say we're going to deliver to our investors. And if we don't, it hurts us. We have our own money in there like an investor, so we feel it like an investor as well. Often the largest investor in each of our funds. But the way that got delivered, it didn't happen exactly on the time. The returns as such were a little bit lower for a little bit longer. But the final outcome in the end is as good as what we set out. It went in a couple of different twists and turns.
So if someone invests in one of your projects, what is the flow of income coming back to the investor? What's it like? Is it regular payments, or is it a balloon payment at the end? Or
so I guess, and it's a good question. The key to a lot of these things, and why a lot of people invest with us in these investments, is they do love the regular cash flow. So first and foremost, putting aside the upside, which really excites us, of course, there needs to be a steady, reliable cash flow, and it has to be a growing cash flow. Because if you think about these investments, when we buy them or when we sell them, what are people buying? They're buying a cash flow, so it needs to be a reliable cash flow coming through. So almost all of our funds are quarterly distributions. They're paid, after right at the end of the quarter on the first day. We have one fund which is a monthly distribution fund, but by and large, the majority of them are quarterly distribution funds, and they're generally very reliable.
And is it purely a function of the rents that are coming in?
Correct.
You guys would have to take your service / profit margin, and the leftovers shared by the investors.
Yeah, correct. And we operate probably a little bit different to a lot of our peers in the unlisted space, in the sense that we have a full operational management team. So everything that happens in shopping centre land, we don't outsource to anybody. We've got the full gambit of management team, everything from shopping centre leasing to marketing to operations. So we manage quite a large team across the east coast of Australia, and then so out of that we manage those assets, we operate those assets, we collect the rent, we pay the expenses, we do all those things that are involved in a shopping centre, and then those proceeds, after those fees are paid to cover our staffing costs, it goes back to the investor.
Obviously, people must say to you, "Well, look, I'm interested," but what kind of return should I expect along the way, and maybe in total when you eventually exit?
Yeah. So we
and be absolutely accurate. It's such an easy question to answer.
Well, look, I can tell you what our hurdle is. When we have our own internal investment committee, which is made up of several people that sit on the board within Haben, and we won't go into anything unless it passes our minimum return expectation. And our minimum return expectation, when you combine, annual distributions, as well as call it an annual capital gain, which is amortised over the investment period, we want to be targeting anything and call it the low to mid-teens IRR return, right? So just say for argument's sake, 12 to 13% IRR is where we like to target it. That's our base case. That's not including the extra value we get from getting a great approval on the site, because we're not wanting to underwrite that. We're saying to the investor, this is the minimum base case, this is what we're backing is going to occur on the investment, and if we get that, then that's a bonus. I can tell you what that looks like only from previous experience on things that we've exited, and we've exited 5 funds to date. All of those funds that we exited, we targeted the base case IRR of the low to mid-teens, but we managed to actually achieve at the end an IRR average to date of about 24%. So it's been an incredible uplift as a result of getting that outcome, which again, we always say to the investor, please be comfortable with the low to mid-teens. We don't want to guarantee that.
But that is ultimately a big return.
It's a big return.
But it's not a term deposit. You're taking a risk.
Correct. Yeah, absolutely.
All right. So tell us about the specific one that you're going to be going into now. This, I presume it's a relatively unloved shopping centre.
Yeah, and look, like all things, timing's critical to getting the right assets. We're in an environment which we've been sitting in for a few years where we're not competing with the large A-REITs, the publicly listed real estate companies of Australia, because they are all dealing with their own issues at the moment. And so that's left a big gap for groups like ourselves to come in and play ball, as well as at the same time you don't have a lot of offshore companies coming into Australia. So there's only a finite group of players that can buy these things, and we'd be one of those players. And as a result of that, when you have one of these groups that then needs to sell something, we're buying these things at a really big discount, a massive discount to what they would have been valued in their peak value, and a massive discount to what we call replacement value. So the subject property that I'm talking about at the moment is the Forest Hill Chase Shopping Centre, which we're...
This is in Melbourne.
This is in Melbourne.
Just locate it for people who might not know Melbourne.
Sure. So it's about 20 k's from the CBD of Melbourne, so in quite an affluent area.
Is it around the Chanston area?
Yeah, we're about a 10-minute drive, so you're in very good company, just to give some perspective.
Well, it's a very famous shopping centre.
Well, the largest and most famous shopping centre in Australia, and the most valuable shopping centre in Australia. Okay. So we're about a 10-15 minute
Is it competing
drive.
with Chanston?
No, we're on the periphery of what we would call competition with that asset. We sit on the periphery of some of the larger shopping centres in Australia, actually, but not really cross-shopping with those per se. By and large, this asset is more of a convenience-led shopping centre, as opposed to Chadstone, which you'd call a destinational outing shopping centre.
So does it have like a Coles or Woolworths or an Aldi or something like that?
Exactly. So to that point, being convenience, it's anchored by all those food and service.
Oh, they're
all there. They're all there.
So it's a reasonably big centre for all three of them.
Yeah. So we've got all three of those. Plus, big Target inside there as well. Some great mini majors inside the shopping centre. Likes of Rebel, JB Hi-Fi. A small entertainment precinct as well, which serves its local trade area. But really, the opportunities and timing to really execute some things that haven't been done on that shopping centre, which it's well due for. And coming back to that story that I mentioned earlier, one of our successes and one of our other assets, this one too has been quite unloved. It's been through a couple of sets of owners, the last two sets of owners that they really haven't shown the asset attention. It's due for a massive refurbishment, which is not complicated stuff, but it's just putting the attention to it and the team to it, which we've set out our strategy on how we want to do it and how we want to execute on it, and really just to improve on what's there, because what you got there is a great big parcel of land with a great shopping centre. It's got a lot of the great big anchor tenants in the country here, so and they're already serving their population, but we need to improve that service to the community so that they have a better experience, and then they shop there more regularly, and more people within the trade area
it
shop
seems
there.
to me that what you have to do, and you're implying you want to do, is you make the place more attractive.
Correct.
But I presume your marketing is going to be really important too.
Big time.
So what's going to be the sort of the magnetic marketing strategy for this unloved shopping centre?
So it's understanding who your trade area is, which is the most important, and making sure you're actually getting that trade area. So when we looked at this asset, we did some demographic work straight up front, and we could see that the percentage of Asian-born within that trade area was almost 20 to 30% higher than the rest of Metro Melbourne. Yet when you walk inside that shopping centre, you don't see it reflecting in terms of the people that are in there. Okay. And then you look at the tenancy mix that's inside there, and you can see it's actually also not catering as well as it could for that. So it's kind of a two-pronged approach. We actually get the tenancy mix a little bit better first, get more of the right types of uses in there to attract the trade area that we want inside there, and then we do that marketing relaunch, right? And that'll be dovetailed with a bit of a cosmetic upgrade, so it looks and feels better, and people will come back and say, actually, that experience was fantastic. It's got all the things I want in there. It looks, feels great, better than its competitors, and now I'm going to keep shopping there.
Well, people say it's an easier place to get to and get parking, because something a big place is it's great.
Yeah.
But parking is really annoying.
You need to have convenient parking.
Yeah.
If you don't have the convenient parking, it doesn't matter what you do.
You definitely won't get men. Men are sharks. We want something, park the car, get out.
Correct. So this fortunately has a hell of a lot of parking, and it's all around the shopping centre on each of the levels, which is great. But one of the things that it fails to do, because there were alts and additions that were done over the years, was actually navigate the customer well. So when you get into the parking, how do I get to Woolworths? All the signage hasn't been upgraded over the years. So it's things like that that's low-hanging fruit that we can come in there and do that.
Is there a capacity to do, like you've done in other ones, like residential potential?
Yes, and very much excited about that piece on this side here, because we are that close to the CBD on a parcel of land that's 10 hectares of land. It's next to impossible to acquire something like that in Metro Melbourne. So we think conservatively we should get, during our ownership and approval, of at least 300 apartments on that site there. Yeah.
But as you say, you might not do it, but that would be the carrot for some other developer to come along.
Correct, to pay that premium.
What kind of time frame are you thinking from start to a situation where an exit might happen?
So we've banked this one as a 5-year timeline. Okay. So we intend to achieve those outcomes within a 5-year period. Most of our funds are either 5 to 7 year periods to do those things.
Is there anything else that, a better question I should have asked you, that someone who's listening to this and say, well, okay, I'm interested, but is there any other question and answer people should hear?
Look, one of the common things that has been asked over the years is, I guess, just the big question about retail and where's retail heading, the impacts of online, and what's that actually meant. And we've been watching this for the last few years across all our assets, and certainly online has had an impact, and certainly online is here to stay. But by and large, where online is really impacting, it's in that discretionary spend, in the fashion, on the online, in that world. When it comes to food service, convenience, those sorts of things, cafes, restaurants, gyms, nail parlours, that sort of centre and that sort of shop has remained and is stronger than ever. And we look at foot traffic data, today compared to in this particular centre, and all of our centres for that matter. And you can see that the foot traffic is still actually growing, and the spend in the centres is still growing.
Does it have a really groovy gym, or is that something that's going to eventually come?
It's got a gym, but not a groovy gym, and that's some work that we'll do on it.
Okay, great stuff. Well, Ben, thanks for coming along. I think a lot of people, are interested in these sorts of investments, but they aren't term deposits, but they are, they offer bigger returns.
Absolutely.
So, great stuff, mate.
Thank you very much for having me on.
Pleasure.
Cheers.
It's Ben Finger from Haben Property Fund.